Well, good afternoon, investors. Welcome to our September 9th, 2025 Bull Sessions. My name is Mark Robertson. I am joined here by my dear colleague who is on the road somewhere in the mid-Atlantic states. Good afternoon, Ken.
Good afternoon, Mark. How are you doing, huh?
Doing pretty good. We have sunshine. It's a little bit crisp here, but warming up, and everything's looking pretty good. We're also joined by Houston's own Matt Spielman. Matt, good afternoon.
Good afternoon.
And Kim has returned from her Scandinavian adventures. Welcome back, Kim.
Welcome, everybody. The 14 days where I miss the rain every day is making up for it since I've been back.
Good. All right.
It's not hurt, so I don't care.
All right, so we've got rabbits running crazy. It is officially red rabbit hunting season, and we'll be doing that over the next several weeks. We're going to focus our attention on Buttonwood today, along with a little bit of Tin Cup, but we will not take our eye off the best small companies, and we'll begin hitting them hard next week. But we do want to spend a few moments with this foundational selling that Ken has inspired us to delve a little bit deeper into. Just a little more structured way of thinking about all those, I don't know what you would call them, Ken, lessons, algorithms, when to sell, notions.
I think lessons is a really great term for what we're going to be talking about, Mark. Things you should be looking for when you're trying to decide to sell something.
Okay, well, we'll get to that. Here is our disclaimer. No investment recommendation is intended whatsoever. This is all about education, and we're very big on the aspect of demonstration. Do your own homework, make your own decisions. If you want copies of the slides, or if you have questions or suggestions for future topics, our 2 email addresses are right there in front of you. Okay, and our Portillo's moment for this week. The stock continues to be mired down in the $7 range. Yes, that is below my cost basis before anybody asks the question. And I didn't, Matt, do you happen to know when did he actually sell the Portillo's? I didn't read the whole article. I just grabbed the picture.
I don't recall it offhand. 2014.
2014. So it has been a while ago, Ken.
Okay.
And I just made the observation, and maybe it's not a kind observation, that he's in kind of the same pose as the hot dog on the lower right.
Mark, you weren't paying attention to the founder's situation when the founder leaves. It always is a cultural challenge.
Well, yeah, but I mean they're doing pretty well in general. But all right, I own a few shares for fun. Everybody out there, full disclosure.
We joke, I think I posted it to the forums. We joke, but Portillo's has one of the highest per store sales in fast food. It is in Chicago, they are above Chick-fil-A. Not Chick-fil-A in Chicago, but nationally. It's $11,100,000 a store. It's crazy. Nationally, they are, I think they're 6,700. I think they're still above Raising Cane's, but above. If you think of places you love to eat, understand Portillo's has higher annual sales per store than In-N-Out Burger, Whataburger, which hits me personally, Shake Shack, which is way down there, Chipotle, which is down even further, Culver's, Cava, and Panera. Pretty impressive, actually.
So what I'm hearing you say is my stock price should be a lot higher.
Yeah, it must. I don't know how you screw up great sales like that, but it's happening.
Mark, we've talked about Cava a number of different times, and I don't know, the last time we talked, you had never been to one. I had the opportunity with my wife and my sister-in-law to go to Cava last night for a real fast food dinner. And we were quite impressed with Cava and the food and the service. So it gets a thumbs up from us as a place that we would stop when we were looking for something fast. Very pleased with what we saw yesterday.
Yeah, I suspect that might come up under as we search for our small companies this year. Just a guess. All right, moving on, because that subject is too painful. This particular week, we are on the verge of autumn here in Michigan. That is to Quantum Falls on the right, one of the more picturesque waterfalls in the United States. That's in the UP, Ken was talking about in the pre-session. And we are in the home building supply issue for the data update. We'll be out with a data update later today, and a little bit more to say about that soon. All right, here's the condition of the stock market. While Ken's been on the road, things have not been, the wheels have not been coming off, so we celebrate that fact. Average return in that 8 to 9% range, so it's in a fairly normal range. The most recent reading, which has only a couple weeks left to go on that quarterly bar on the right, which represents the value line arithmetic average, has peaked above that long-term reasonable expectation trend. So, Ken, any thoughts while you've been out being rambunctious?
Well, I just got an odd question. I don't know, 3 or 4 days ago, right before we left to go on our tours here. And somebody asked me and I couldn't answer it. So I said I would try to find the answer when I next spoke to Mark. If you look at the light green bar, you'll notice that the upper right-hand corner is above the red line, but the upper left-hand corner is above the red line, and the upper right-hand corner is on the red line. And which do you read when you read the graph? I know that's a very exotic kind of question, but I'm asking it on behalf of one of our viewers. Okay, could you tell me an answer, Mark?
I would look right in between those two spots.
Well, that was my instincts, although my second instinct was to look in the upper right corner. But either way, it's close, folks. You don't have to really obsess over whether you're looking at one quarter or the other. It's either on the red line or it's slightly above it. That's enough for what we're doing. Remember, folks, we're doing everything with crayon, and with crayon, it's messy a lot of times.
Yeah, that question comes dangerously close to getting a crayon thrown at you in one of Ken's manual classes.
Well, I'm sure it came from an engineer. All you engineers in the audience that want us to do things with 4 decimals.
In that case,
so we don't.
In that case, grace is granted. Any engineering stuff is welcome here. All right. Speaking of grace being granted, here's our performance perspectives, kind of back to normal with a 10-year trailing look back. The 10 company names that you see here are the 10 most widely followed companies at Manifest Investing by the subscribers in terms of the number of appearances on dashboards, if you're curious about that. So you can see the performance of 8 of the 10 is pretty robust. 2 of them are basically holding up their end of the rule of 5, which is that probability distribution that we admit that no matter how much superhuman homework we do, things go wrong in the choices that we make. And you're going to have a couple that underperform out of 10. There's going to be a couple, like look at the one up at the top. I don't think anybody 10 years ago could have predicted that level of performance. I do know people who were predicting strong performance. Ken's related to a couple of them. And but I don't think they predicted that level of performance. Did they, sir?
No, not at all, Mark. SSG's back from that time period. And I have one from almost when we bought the first NVIDIA stock. We're predicting par values in the upper teens. They were never predicting 60% plus return values. So I also have taken it upon myself, Mark, when we show charts like this, to begin to just mention on a regular basis how aggressive the beat the market by 5 points goal is. And therefore, anything from the tin cup demonstration on up is really, really doing well. But the returns from Visa, the Round Table, and Home Depot are nothing to be sneezed at. Anytime you can beat the market by even a single percentage point, you are doing extremely well in your investing endeavors.
Yeah, and of course we don't pick on index investors. Index investing is appropriate for a lot of people, and it's a good thing. But we just want people to be aware that you are settling for something in that range long term, and that's okay. We just think that we demonstrate every single day that it is possible to achieve those higher numbers, and those higher numbers are exponentially powerful. There, I just did that for the engineers, Ken. Exponentially powerful.
Great.
So yeah, it makes a lot of sense. We also would like to celebrate that the Buttonwood Bulls has at least attached itself to the bottom of this chart. And they're a threat to move on to the chart.
It's certainly going to keep us humble for a while, isn't it? Okay.
Well, it's been working so far.
Yep.
Pushing out the humility like you wouldn't believe. All right, so we are going to talk about the Tin Cup demonstration portfolio for just a few minutes here. We'll get to that. But here is one of the simplest charts I've seen in a long time that I knew would actually make Ken smile.
Yeah, it's just showing 30-year returns, folks, for 90 years actually, by 30-year blocks, and it just makes the point that number that we've been talking about for so long, that 10%, plus or minus 1 or 2, that number is there, and it's been there for a long, long while, and we know that that's a great return. So if you're only investing in the S&P index, that your return's been beating inflation and been keeping you above water. But we also know that a goal of trying to beat those returns is what we're aiming at. Notice all the stuff that went on during that last 30-year period from September 95 to August 25. All the things that were supposed to tank the markets and make investing unreliable and not very profitable. And in spite of all that stuff, and there's some pretty serious things on that list, in spite of all that, we still have a 30-year annualized return of 10.4%. Pretty decent.
Yeah, it's pretty.
I can't believe that they left out the lost decade, right? Which made so many people so nervous about things. It's right in the middle of that.
Yeah, it is.
Absolutely, man. Absolutely, yeah.
Yeah, and that LTCM collapse, that's long-term capital management, that was a big deal. Back in, I think, 1998, it was a moment. And the great financial crisis, that was if not the worst, the second worst. Here, I got to finish in the history of the stock market. So this will be lost decade.
That LCTM or that LTCM collapse might be identified in some lists as the savings and loan collapse. That's the same thing, I think, that they're talking about.
Same time frame for sure, yeah.
Yeah, same time.
No, that was about a decade earlier. That was the Black Scholes. That was the options guys.
Oh, okay. All right. Thank you, Matt. Exactly. Yeah. That makes sense. Okay.
That was the experimental failure of the efficient market hypothesis. Efficient markets are great, but then Russia's in the room.
The savings and loans might have been in the bar in the middle then. Yeah.
I think it predates that range a little bit, but so there were things between. It was definitely in the middle one. Yeah.
Yeah.
In fact, I'll say that the retirement year that defines the 4% rule, meaning the worst time in historical time frames you could retire was 1966. So not far off from that.
Absolutely. Good stuff. Yeah, a lot of things have happened.
Even us old folks weren't even investing in 1966, Matt. So that's good.
I was, and Kevin Gologly should have been investing in McDonald's, so we'll just leave it at that. All right. Well, checking in on our friend Tom Lee and his exploits. Excellent sessions going on. He updates the Granny Shots portfolio. That ticker is GRNY, and we do follow it. He's doing very well, and let's hope that that continues, because it seems like every time I pay attention to somebody like Tom Lee, they fall off the horse or something. But one of his messages is that the small and medium-sized companies have been really in the doldrums for so long, and their businesses are looking better and better. At some point, the stock prices have to begin catching up, and he catches a little bit of grief for that. Ken, what's the latest on Tom Lee?
Well, I don't know if it's about Tom Lee or not, Mark, but I noticed that Alphabet is on the slide, and my biggest holding that I own personally, my wife and I own, used to be Microsoft, and Alphabet overtook Microsoft about a week and a half ago when the government suggested that they were not going to break the company up, and Alphabet took a pretty big step upward, maybe 10 or 12% upward, and it now just nudges out Microsoft as my largest holding. And it's interesting that the small guy still is interested in a company like Alphabet as well.
Absolutely. And I will do a shout out to Bakul Lala. He's on the call here today. The Golden West chapter of Better Investing is actually featuring Arista Networks in a month-long educational series led by Bakul. And you can find that at the Better Investing website. If you drill down into the Golden West, that's California chapter, and they call it the Friday night sessions that they have. So
Mark, we have in the air a new name to the bull session, Kimson. And Kimson, you're unmuted. Go ahead. What would you like to tell us?
I just want to comment on Matt talking about the last decade. The last decade is not an event. It's a period that included all the event. So they are right.
True.
In between the .com bust and the 2008 financial.
Yeah, all that event happened in the last decade. So that's why the last decade is not the event. They are talking about all the event that happened during the 30 years.
Sure. I just think, Kimson, that had a lot of media attention for a while. For a time, investing in stocks was hopeless because of this last decade, and now, your point, it was always kind of
2000 to 2010. It's a lost decade, but then that's not an event. That's not an event. They are talking about event, like Asian financial crisis is an event. .com bubble is an event. So that's what I'm talking about.
We'll please both of you, and we'll put it in parentheses, okay? As an identifier to what the events are. So there will help both people feel happy about it. Thanks, Kimson, for your comment. I'm going to put you back on mute again.
And we haven't given it a star. Okay. All right.
As you said, Ken, at some point, they've all been reasons not to invest or to get out of the market.
Yep.
Absolutely. And big reasons from the talking heads a lot of times.
All right, moving on to our Groundhog Challenge. We're getting to the point where it is a little more stable and people aren't moving up the list as much as they had. One individual moved from somewhere around 100 to 73rd, but he shall go nameless. Everybody's positive. I think the monkeys are positive.
I think George going from 77 to 50 is a pretty dramatic move.
That's true.
And I think we had a second one that I spotted on the list here. Julie Meter going from 59 to 27. She cut her number in half. So that's a pretty dramatic move as well. So we still have a little bit of dramatic stuff going on, but not nearly what we saw earlier in the contest. And that should be expected, I think.
I take great hope in that.
So we're kind of just trading places in the top 12 or 15 spots. Occasionally somebody new enters. Congratulations to Sandy that has gone from 21st to 11th. But the top 12 or 15 people have stayed relatively consistent for the last 3 or 4 weeks now, just kind of up and down a little bit and everything. So we'll see how this thing begins to, we're on the downward slope now, past the 50% mark in the contest, and we'll see how it plays out on the way through to February 2nd.
Good stuff. And by the way, for anybody out there wondering, there was one contestant that had Walgreens, and I had to pay him out at $12 a share. I think it was Pedro Ortiz. So there was just one person selected Walgreen for this year's Groundhog Challenge. Which
that was Pedro's wild bet. Turnaround bet.
Nice turnaround.
He has a spicy portfolio normally, so he'll get that joke.
Yep. Good stuff, guys. Everybody's positive, and with the exception of a couple people hovering around at the bottom. All right. Let's talk Buttonwood portfolio for just a minute, and then we're going to take a detour to Tin Cup and come back to Buttonwood. But things are improving. The numbers are actually heading north in the right direction. Green Brick Partners had a pretty good report. United Therapeutics had a huge report, picking up about 40% in one morning last week. So all of that adds up to a much better performance for Buttonwood overall.
We also had a 40%. Oh, it's not in this portfolio. I was going to mention MedPace, but I'm sorry, United Therapeutics, but it's not in this portfolio, is it? Okay.
Yeah, United is, and MedPace is in our best small companies, and both of those companies are.
Both of those companies are, yeah.
So
I'm looking at the report card over to the left, Mark, and I'm just reminding folks that the intermediate goal for par is to try to stay 5 points above my par, and the absolute goal for par is to try to move that up to around 13, 14, 15%. So at the moment, that 11.8 is almost 4 points above my par, so it's certainly moving in the right direction. Quality, you hardly ever see a better investing portfolio that doesn't have quality in the at least at 80 or above, and that growth number is the only one that's a little bit where we little bit less than we'd like to see it. I still think that our goal is 12 and a half, and I wouldn't even be adverse to seeing something close to 13 on that growth number.
Yeah, 13 as long as we don't get carried away and too adventuresome.
Well, as long as we don't move the PE up to 47, yeah.
Right. And this is still fairly conservative, and I'm not too worried about it. Here's a look at that chart, which we've been tinkering with for a little while. It's a little bit tough to read. On the left-hand axis, you have everything denominated in dollars. That covers the future value, which is the green. That's an estimate. And the blue down there is the actual balance over time in dollars. So those are both plotted against the left-hand y-axis. The right-hand axis keeps track of the portfolio par that's straight off the dashboard, literally the average return forecast for all of the companies in the portfolio. And you can see that as they have done better and better, the par has come down a little bit. And of course, our actual rate of return down at the bottom, that is in percent also annualized. And both of those are graphed against the right-hand axis. So, Ken, this has to make both of us feel a little bit better. And we have been served a huge helping of humility with this portfolio in the first few months.
Absolutely. But I think we're getting more to the point where we feel that it's a much better long-term projection and a much better representation of our philosophy as we tinker with it a little bit. Mark, if you'll write a note to send me the brokerage transactions from the last 5 or 6 weeks, I'll update our record keeper, and I'll show a record keeper either next bull session or the one after about where we are with that particular document.
Will do. Duly noted. And here's just a public service announcement. We have gotten the question a few times from too many people. We do not believe that you should ignore earnings. We think you should place them in proper context. And that the same thing applies for PE ratios. Don't ignore them. Just do your best to keep them in appropriate context. And our obsession with the cash flow aristocrats is based solely on the fact that you look at that list from top to bottom, there's some pretty good companies in there with fairly robust long-term returns. So as the bottom box says, and the only reason it's coming back for a third time is we did add Charlie to the list of people who believe that cash flow is also something you want to pay some attention to and attempt to understand and appreciate. So that's all this is about. And we think our perspective and position is reasonable. So there.
I've been saying it in a slightly different way, Mark, that up straight and parallel is great for sales and earnings. I'd love to have price moving in the same up straight and parallel direction, and having cash flow do the same thing just makes everything better.
Yeah, and when we get that flat spot, like you see down the middle of that chart in the stock price, that just simply means that whatever company this is was getting more attractive for a couple years. And that's one of the things that we know and believe. All right, so let's go ahead and turn our attention.
Opportunity, not risk.
Opportunity, that's right. Manifesting opportunity. All right, let's talk foundational selling. Again, this isn't anything really new other than maybe putting everything, the type of notions and processes, whatever the word is, with respect to when to think about selling a stock, and especially in the context of impact on the overall and total portfolio. So that's what we're going to talk about. Going to first look at Tin Cup and then come back to the Buttonwood portfolio to actually demonstrate this a little bit. We are having some fun with Tin Cup. It is actually on the cusp of $5 million again, and I just ruined it. I'm sure that it will close down significantly today now that it's been mentioned. But we had one day above 5 million about eight or 10 months ago, Ken, and you can see that it has not closed a month above 5 million in the last several months. For those of you that are unfamiliar with Tin Cup, it's a portfolio which was inspired by North Carolina's Dan Hess back in the mid-1990s, where we basically are just simply trying to buy stocks in the same manner as Walter Schloss and the Modern Investment Club movement. And what we basically do is we take and pretend that we're maxing out a 401k since 1994 and investing the maximum amount that you could put in a 401k into the actual individual stock selections. It's a managed portfolio. It is generally, although it hasn't been true for the last couple of months, generally 100% invested in cash, in stocks, 0% cash. I was getting closer to that other condition, but no, that was just sheer laziness and hiatus, but we'll talk about that. But pretty impressive performance. Again, nothing wrong with the red line, but most of us prefer the other. Anything you want to add to this, Ken?
Not at all, except, Mark, I've been fooling around with an analogy that seems to be resonating with my audiences. And the analogy is maybe you need to start thinking about your portfolio. We used to use the analogy of a garden. And I've lately been talking about a forest and the trees in the forest. And that seems to fit a lot of the things we've been doing a little bit better than the old garden analogy. We want you to see the forest, not the trees particularly as a beginning, but look at the forest as a whole. Look at the portfolio as a whole, and then do what you need to keep the forest healthy. And that might mean occasionally removing a very healthy tree and replacing it with even something that's more healthy. So keep that analogy in mind, and if it's useful, we'll come back to it a couple different times in the next couple of years and see how we're doing. The Tin Cup is a forest of stocks. That's a mixed metaphor right there, but Mark's going to make some suggestions to get rid of that $632,000, which is 4% of the portfolio.
Yeah, this never happens. I mean, we basically sold off a couple of companies, including United Healthcare. I don't remember whether it was before or after the price drop, and I'm not going to look because I don't want to know the answer. But yeah, that generated a pile of cash that we have, and we obviously want to do something with that. And here's the current condition of the portfolio. You can see that the portfolio has generated this 15.9 that you see on the performance perspectives every week since the mid-1990s. So here is...
I said it was I said it was 4% of the portfolio. That's what it was returning, about 4%. It was actually about 13% of the portfolio.
Yeah, and that Ken breaks out in hives when that happens. So
that's too much cash.
That's too much cash. All right, so here is what Ken has inspired us to take a look at, and I'll take my shot at it. What I think it offers the potential of doing is basically taking the stuff that we talk about, the procedures and thought processes and everything else, and captures them in one spot. And with the 10 cup portfolio, you're dealing with a fairly small number, but it does. I need to widen that column. Percent of total, that needs to be widened. That should say assets. It borders on wrecking our PG-13 rating if we're not careful, Ken. Yeah, so that's the column where you would basically watch for a portfolio position becoming too small or too large. I would argue that Novo at 2.7 is probably too small and merits consideration for adding anyhow. And that's where we will end up. But yeah, how do you walk through this?
Well, we just want to start by, I think, telling people that they're managing a portfolio to count how many stocks they actually own. This is a 10-stock portfolio. You can count it right there on the chart if you need to. And in a 10-stock portfolio, an average holding is about 10%. So I think, Better Investing has suggested, George Nicholson has suggested that when a holding's less than half of an average size, it's time to either buy more or cut it loose, unless you have a very specific reason why you're keeping it very small. So half of 10 is 5, and we would like to bring Novo at least up to 5%, and I think Mark's going to make a suggestion to actually triple the position and bring it up to around 8%, which is still smaller than average.
Yeah, by that same line of thinking, if a stock position got up in that 20% range for a 10-stock portfolio, it would merit watching for opportunities to selling opportunities. So as we
And I'd like to stress there, Mark, that that's not an automatic sale at 20% of the portfolio, but that's the time that you start asking yourself questions about the size.
The internet's getting a little bumpy, so I hope that doesn't continue.
Yeah.
All right, so what you see is on display some of the characteristics that we care the most about for the portfolio. We want the return forecast. You can use either the par or the prove. They're roughly the same for the average company. We basically want to maintain that at a sufficiently high level. So we could be talking about selling some of the lower ones, or basically reaching out of the portfolio for some higher return characteristics, but generally keeping that, as Ken was just saying, closer to the average stock plus 5%. And there's only one there that bothers me a little bit, the Service First with a fairly low proved number. So it's just flagged as you might want to check this. We'll do a quick audit of it.
Well, it's a wonderful example, Mark, of how we can use prove to validate our par calculations that come from a typical stock analysis. And when they're that different, when prove is 5 points less than the par value, one of the two is probably off a little bit. And since prove is based in a little bit more data with a little bit less forecast than par is, probably our par forecast is a little bit high for what we're looking at here.
Absolutely. And there's nothing wrong with Service First. It's a wonderful company, very high quality company, but it's just a little bit bland for some of the stuff that's been very successful for this particular portfolio. So again, that key column that we talk about so often, you really want this to add up to 12, 13, maybe even as high as 14% for a younger person. And so anything that's on the low end, your Gentex, your Green Brick partners, they should be on some form of a hot seat, basically. But you want that 10.4%, that average, to be, again, 12, 12.5, 13. something like that. So this also gives us a look at, although how a stock has done versus the market is not really a deciding factor when it comes to this type of analysis. A little bit more so when it comes to perhaps tax loss reasons, tax-related selling. But you can see that some of the ones up at the top have carried the portfolio pretty well here lately. The RSI refers to the Relative Strength Index. It's a 14-day look back, and we're simply looking for stocks that have been hot. Anything above 70 is deemed potentially overbought, overvalued. Anything above 80 is even more so. So we flag them at 80 and then basically say, do we want to lighten up here or perhaps exit the position? So Ardelyx has been hot, so has Google. And the opposite end of that is companies with an RSI below 30 or perhaps even below 20. Those can be an opportunity to sell. You see the purchase dates, the number of shares in the particular portfolio. Some of these companies like Amazon and Alphabet have been in there for a while. So has, I believe, Gentex. So, you know, Ken, we do a lot of... Go ahead.
I think you're saying, Mark, that relative return column is history.
It's
there for reference, but the important column, if we're talking about anything about return, is that return forecast column, that PAR column.
Yep.
Of the two, the relative return number is there just for reference. And we thank the stocks that have high relative returns for making the portfolio what it is, but it's not necessarily telling us what that particular stock will contribute to what the portfolio could be in the future.
And of course, that huge return for Taiwan Semi, we nod in Nick DiVirgilio's direction. He says that we should own semiconductor stocks, and he stands by that. Good stuff. So you can see the balance today, right now, is tickling up against 5 million, which will no longer be true after we hang up and the market tanks our stocks. But all right, so
Mark, I think you should put a big picture of a snake in the bottom of this thing here with, okay.
All right. So our first decision is relatively easy. We do not have a very large position in Novo Nordisk. We're going to actually take a closer look at the company, and I'm just basically saying let's spend some of the cash and dedicate it over to Novo, because I still think Novo, even though it's in an intensely competitive environment, is one of the two top companies in the field, in the GLP field. I also think that here's a look at the company. I do think that the change in management is proving to be a positive, at least so far, the stuff that we read and hear about. And I also believe that, you know, the playing field has not changed for these companies, Lilly and Novo. A lot of competition. That's a given. They've been facing competition for, pretty much 100 years. So they know how to do that. The other thing I would point out is that there is evidence that the GLP-1 stuff is going to extrapolate to other afflictions, not just obesity. And that's an unknown, but one that is likely to be there. So you see a fairly strong company with, you know, 15, 16% returns, 12% growth rates, and really normal average PE. You can see the bump up with the GLP-1 stuff here. And this is a fairly solid picture for the growth expectations. Profitability's been good. You see the ramp up in stock price down at the bottom. So I'm just basically saying, hey, a lot of cash flow at the company. I would point to that profitability graph, specifically the operating margin, as pretty much steady as a rock, despite some formidable competition. And the value line average return forecast right now sitting in the low 20s, pretty attractive. So that's my rationale for going ahead and adding a position in this company. Here's what it looks like when we actually take and divert cash into the Novo company. So we now have 8.1% of assets in Novo. This change alone has tacked on a tiny bit to the growth rate of the portfolio, the sales growth forecast for the total portfolio, and a decent chunk over on the overall return forecast on the far right. there's still quite a bit of money in the portfolio. So basically went through the analysis of what if we challenged service first, because again, I think it's kind of a, challengeable under this condition here, the 7.5. And, if we were going out and replacing it with a similar company from a related asset-based company field, you might look at these companies. Again, notice we searched by just financial, so it's going to be banks and insurance companies for the most part. And I basically said, show me if there's anything out there that's equal to or better than Service. What's the name of the company? Service First.
Service First. Yeah. And Mark, I know it's a repeat, but based on the proved number, that 7.5 that you pointed out might be even a little bit high for the company. That's a really great reason why we're looking at it.
Yep. So my attention was drawn to this one. I presented that at the most recent roundtable. Brown & Brown, they're in the insurance brokerage business, not a direct insurer, but basically a company that's in that realm. And I do think that they have suffered a little bit, probably unfairly, with all the turmoil going on in the insurance field in general. So pretty solid company, a community favorite going back multiple decades in our community. So basically said, let's go ahead and take advantage of this high quality and this high return forecast as being superior to what you see over here, which are the conditions at Service First. And what happens if we actually take Service First using the worksheet out of the portfolio, replace it with Brown & Brown right here, we get pretty nice numbers. A bolstering of overall growth, a bolstering of the return forecast. And again, this is a March. It's a marathon, not a sprint. Here's a look at Brown & Brown. It is one of the cash flow aristocrats, well-run business, and just pretty good looking picture. Quality, check. The return forecast at multi-year highs. This is a pretty sales picture, pretty earnings picture. This is up straight and parallel. And the price has behaved pretty well. And profitability looks good. So that's the change we're making.
The only thing I would add, Mark, is that we're not buying an insurance company. We're buying an insurance brokerage, and they're very different kinds of companies. The brokerage company can be studied using the kind of analysis that you're used to doing for any other company that sells stuff. The insurance company needs to be studied a little bit more with their asset base rather than the fact that they sell things as well, but they sell insurance. So we're looking at people that sell things that insurance companies provide.
Mm-hmm. And then just for kicks, what else is out there with a relatively high projected return and decent quality, double-digit growth? And not a whole lot, although this one has captured Ken's attention. I'm certain that we will be taking a closer look at Duolingo. What's your general impressions and what draws your attention to it, Ken?
What draws my attention to it, Mark, is talking with two different people. One of them in Atlanta when we were there speaking, and one of them at the North Carolina session I just finished, with both of them indicating that they were secondary teachers and Duolingo was being incorporated into their curriculum. If that becomes something that starts to happen nationwide and then maybe even worldwide with people that are teaching languages, the incorporation of a completely different way to teach the language, then Duolingo probably has a head start on a lot of different companies in providing the materials to make that happen. I think that's enticing with a market that is virtually untapped. we have not changed the way that we offer foreign language instruction in the world in probably the last 100 or more years. So finding a different way to teach foreign language, which is what Duolingo claims they've done, is a very interesting concept. I also would point to a couple of these companies that we have on our small company list from last year and might be a repeat. And then I'll also indicate, Mark, the very high interest in Nintendo. If you do some very basic stock screens, I was extremely surprised to find in the North Carolina presentation that when we were doing real-time stock screening, Nintendo was rising to the top of some very, very tight screens. So I would like to take a real serious look at that company as well.
Yeah, I suspect that it's going to be tough to defend this hill right here. So
well, that's the number. That's the number that I want to be able to figure out where is it coming from, because right now a number of 43% is extremely aggressive.
Yeah.
So we'll have to see if that number holds water.
The other thing I would point out is normally I would put a maximum here just to avoid temptation, and that would have ruled most of these out at the top. You know, just put a limit on that, because again, you get too far into too good to be true land. I would get that one too. You're basically on thin ice. It could work out well, but it's just a level of sleepless nights that I'm not willing to live with.
Yeah, I have a general rule of thumb, Mark, that I'll keep the yellows in as long as they're less than 5 above the top of the sweet spot. But you're absolutely right. There's a number at the top of the list, and that might even include Duolingo, that are a little bit in rarefied territory. So we're looking at ideas right now. We're not looking at things that we've settled on, but just ideas.
Yeah, this is just screening, so keep that in mind. Double Verify is an interesting study that Susie Artsberger has presented a number of times, and we did choose Opera for one of the roundtables a little while back, and that's basically an internet search engine that's focused on the gaming community out there, which is apparently fairly large.
When I asked some of the AI engines to give me some small stock ideas, some fast-growing stocks ideas, UFPT kept coming up on those lists too. So I've already given that to you as a candidate for our small company list, Mark, and it is on this list as well, right there at the cusp between yellow and green right there. And that's a place that a lot of times we'll go looking for really serious candidates.
Yep. Kind of a sweet spot for searching. So the moral of the story is we basically accumulated more Novo and added Brown and Brown to the portfolio, and you can see the change made in the portfolio. We picked up 0.6% in the overall growth rate of the portfolio and 1.5% in the return forecast. Again, it's a never-ending challenge, but those are both moves in the right direction. We knock on wood, throw salt over our shoulder, and move on.
Well, and there's still a significant amount of cash in that portfolio at over 300,000. So there's still room to do a little bit more additions, maybe at the next roundtable or the one after. But I think we need to do things slowly and methodically. We don't do things real quickly and in a huge batch all at once.
Okay, so that's the current status of Tin Cup. So let's talk Buttonwood Bulls using the same notion. A few more stocks in this portfolio. How many do we have in here, Ken? 16?
I thought there was 16, Mark, but we might want to recount.
16-ish, anyhow. And
yeah, there is 16 right now. Yeah,
gives you a really, really nice look at percent of total assets. That's the GP13 version of that column, and PG13. And you basically can get a look from bird's eye view of the entire portfolio, looking for any areas of potential concern or things that you want to scratch your head over a little bit more. We always counsel that the lowest pars deserve some attention. In this case, the 3 lowest pars are there because they've been doing very, very well. and perhaps the fundamentals haven't caught up yet. But I didn't even bother to put any of them in yellow, Ken. We're not going to sell. We're not going to think about selling these.
I agree. We have to give the analyst community time to catch up to what's actually happening. They lag a lot of times by as much as 2 or 3 months in getting caught up. When you look at, especially when you look at printed sources like value line sheets and things like that. So I agree. Alphabet had a huge run up less than a week ago. IES has just been on a rip-roaring tear for about 3 or 4 months. And Visa had a strong last couple, maybe 6, maybe even 8 weeks. So we'll just be very patient with those 3 at the moment, at least.
Yeah, and for those of you that like to put it into words, especially George Nicholson's words, founder of the National Association of Investment Clubs, anytime that the growth is in double digits and you're dealing with a quality company, which is the case here, they get kind of a pass. Or the other way to think of it is that return forecast had better approach 0 before you think about selling it. Even find negative territory in some cases. So,
or at least approach cash return, right, Mark?
Right. And that's the other thing, putting it in this display, here's the cash number that you're shooting for. Anything that is at or below that number would be automatically on the hot seat. So that's kind of a neat aspect of this. There is no tremendous concern with respect to quality for any of the companies here. And there's 2 companies in the middle there when it comes to the growth forecast. Ken has suddenly developed this, I just want to say he's being belligerent about companies that have less than 8 or 9% sales growth. But
yeah, but I didn't first use the word annoying. I think you did.
Well, in the case of those 2 companies, both Gentex has been kind of stuck in the mud for a while. Schlumberger, I've had Schlumberger in personal accounts at least twice, maybe 3 times over the last 30 or 40 years, and they always seem to disappoint me. And we actually talked about this when we added it to this portfolio, Ken. And I don't know. I think they're beginning to fall into the class of companies. They talk a good game, but then don't necessarily always fully realize the full game or something. And that's why I call them annoying.
I'm starting to get audience reaction about my annoying stock in this portfolio, and it's Lululemon. So we definitely will be looking at Lululemon as we move forward as well. But right now, Mark is fixated on Schlumberger, and I don't have any problems with removing Schlumberger from this portfolio. I've only owned it once in my investing history, and it was a quite disappointing purchase at that time. I tend to stay away from anything involving energy at all. I just don't seem to understand it very well.
Understood. And the proposal that I've made here is to basically, because it's just more pleasant to set Schlumberger free. Everybody here should probably buy Schlumberger tomorrow afternoon and enjoy the uptick. But I think moving the money over to NICE and Texas Roadhouse, we'll take a look at all 3 companies here to audit them, but they're the smallest positions down at the bottom. I share the reservations about Lulu. I would just urge that many of the problems that they face, first of all, they're not limited to Lulu. Second of all, they're probably an overreaction, the tariff stuff I'm talking about. And this one suggests that maybe it's been a bit of an overreaction. I will probably eat those words a month from now, but just kind of leaving that alone and just hoping. Is there a price to hope ratio coming in here, Ken?
Well, they actually make money, so I don't have to. We don't have to revert to price to hope. But I do feel we've been getting a lot of traction on the forum, also the Manifest forum about Lulu, and it's not very pretty, some of the stuff that's being printed on the forum. So we definitely want to keep it in our sights as to why the heck are we holding it. If we do sell Schlumberger, that'll give us a 15 stock portfolio, and that'll make our average holdings somewhere around 6.5%, somewhere in that particular neighborhood. And that's a great size portfolio. I love the tagline 16 plus or minus 4, and so that keeps us right there with sufficient diversity. And at the same time, we've done some serious thinking before we do anything rash or drastic in this portfolio.
All right, so let's check in on the three. Yeah, they're going through some stuff, and that's the reason that this is so high. It's kind of like when a SSG based stock study has an upside downside that's 14. The quality has drooped a little bit on the far right, some of the pressures that they've been under, and this is probably the thing that bothers me the most. I think they have the bends, and the only question is how temporary is the condition. When you start losing cash flow, and it's definitely flattening out, how temporary is the situation? I don't know, but it certainly is a bit frustrating. I would point that Value Line has them currently at a 21% return forecast. This is also a possibly oversold condition, undervalued. So maybe we just hang on. No matter what we decide here, Ken, I think that $137, or what is it, 165? Yeah, 165. If we lose half of that between now and next month's meeting, it's not going to stop the world.
Well, I guess we could lose the entire value of the portfolio, and it's not going to stop the world. But I want to remind people that are new to the bull session or to manifest investing that you are looking at projections on some of these graphs. If it's a 25 or 26 or later number, those are all projected numbers. And Mark and I both feel that looking at projections is an extremely valid thing to do when you're trying to create trends. So just keep that in mind if you're looking at these graphs.
And here's our friend Nice, which has continued to be, it's a little less annoying because I think we have a reason to be less annoyed here. But this is a company that's in call center management and a few other things, regarded as a world-class participant and provider, and just very respected. They do happen to be headquartered in Tel Aviv, Israel, and that's part of the problem and the reason that this has been pretty lackluster. They did lose their CEO, but everything seems to be firing on all cylinders, as you see here and as you see here. So that's kind of the situation. And again, we refer to this company as one of those companies that was cool, where artificial intelligence was actually happening before it was cool for everybody else. So
yeah, I know your eye might be drawn to that flat line on quality, but a flat line up near 100 is not a bad thing. So
no, we like flatlining up there.
Yeah.
And then what are your thoughts on Texas Roadhouse? Is Ann Cunias still hot on this company?
I don't know about Ann, but I still think that if you're going to move into consumer discretionary, that this is one of the stocks you might to consider. They have been very public about the fact that they're going to keep their margins at the low side, their profits at the low side, and they're going to try to fill their restaurants on a regular basis. And Texas Roadhouse, the style of the restaurant might not be for all of you in the audience, but if you were to ever go to one of those at almost any time during the day, I think you will admit to yourself that it's always filled with a lot of people. So this strategy of lower margins but higher volume seems to be working quite well for them.
Yep, pretty formidable company, and you can see the return forecasts are fairly robust. Decent double-digit returns, EPS growth forecast in the mid-teens. There's a lot to like here. This is one of the more obvious COVID-impacted companies. You can just set 2020 aside, because that was clearly an annual event of great consequence for them. So we'll leave it at that. Not going to spend a lot of time on these other than to celebrate the fact that Cowboy State Daily is now a daily newspaper for me, thanks to Betsy last week. And we are going to be covering a lot of turf, including most of these spots over the next several weeks. And we'll just leave with one tease. I promise that between now and next week, I'm going to go back and visit this list, including a whole bunch below it. The Russell 2000 Growth ETF. This happens to be the VTWG ETF. And when we were shopping for companies a year ago, this is one of the screens that we finished with. And we X'd out companies that didn't have earnings and companies that were too big, like this one's maybe a little bit too big. And we kind of went down the list as we were making our selections. Well, I left them on the spreadsheet that we used back then. And we'll be looking at a modern version of this. All of these price changes are since last Halloween when we made the selections. And we think that it's probably very prudent to pay attention to, you guessed it, the growth forecast for the companies. But we also like to look at the tailwinds that come with a sales forecast for 25 over 24 that's pretty robust. These are some pretty good numbers also. And as Ken said, we probably should have just taken this list and gone home.
would have made our job a lot easier, Mark.
But they're not all small, and what fun would that be? You wouldn't have got your nuclear company in there, Ken. But those are some pretty interesting results, and again, we want to make sure that all of these are current and up to date when we take a look at them, if not next week, the week after that, and begin ferreting out some pretty good candidates for the next year. Any other thoughts on this?
None at all, except we don't want you to look at the quality of one of the companies on that list and draw the conclusion that that's the kind of company you should invest all your money in. So I think I'm drawing attention to Bloom Energy with a quality of 17 and a total return of over 400% for a year. Those companies exist, but a lot of companies with that kind of quality show numbers in the opposite direction that are just as large.
You will get as many or more strikeouts as the home run that you see on the screen.
Yeah.
This is what it boils down to. All right, we'll be tackling this with probably a month out from September 16th. The book comes out, David Gardner's book, Rule Breaker Investing. He promises that this is his magnum opus, according to Matt Spielman, and we agree with that. Here's a reminder that we do archive all of these sessions on YouTube if your day job gets in the way or just simply your next trip to Costco. All of the roundtables, all the bull sessions are here for you to go and grab. And here's that speech.
I want to compliment Matt for making me think on a regular basis. He reads a lot more serious stuff than I read, and he's always putting quotes up in the different sources that we share with each other. And Matt, are you going to be the first one to read this and just select the best quotes and tell us what they are? Okay, please.
Oh, okay, please. First, I'm glad you don't find me annoying. That's not too much. I'm in the middle.
It's not too much at all. You really make me think, Matt, and that's a great thing. Okay.
I'm in the middle of research for one of my bank topics, which is going to be investing in groups. So I between this and then the Babson book, which I have to read. I have to read on a real paper thing. I do have a copy, not electronically. I don't know if I'll fit that all into September, but I'll try.
I have a copy of the Babson book that's so old, I'm afraid I'm going to break the pages when I turn them. So
you need the white gloves. You have to hold it with the white gloves.
And I don't want to brag, but I have a signed copy of the Babson book. But hey,
yeah, but you stole it from someplace. So
yeah. Kevin Golugly accused me of signing it. So there you go.
We did. I had a study group. It wasn't an investment club, but it was kind of a finance discussion club, and we were discussing Jason Zweig's book, Your Money in Your Brain, and he got one used. Instead of buying a new one, he got one used off Amazon. It was autographed for no extra price. I'm like, oh,
Excellent.
yeah.
All right, so that's all we've got for you investors today, other than to point out that the blood moon was pretty good. I slept through it, but the Detroit News took a good picture of it for me. And Ken, that's my public service guide for you as to when the colors change in Michigan.
I'm going to be up in the Traverse City area, right in the middle of that kind of buff-colored time at the peak of color season. Fall is my most favorite season of the year, and we're going to be doing a lot of leaf peeping up there during that particular time. I'll still make it to roundtable and I'm sorry, to bull sessions, and maybe I'll be able to get some pictures for you even, Mark.
We'd appreciate that. And the one on the right is cheating, but I thought it was kind of cool. It's a compound photo, but that's our Mackinac Bridge. But good stuff. All right. Well, with that, again, we appreciate the small company ideas. We will be going through them very actively between now and Halloween. So thank you for any suggestions or pointing that you'd like to do. And with that, Ken, any closing thoughts?
I'll be home Thursday to start some of that work, Mark. So give me a chance to get on the road and get back home, and then let's get started on it, okay?
Okay, and I'll take a look at a couple of things you asked me to take a look at. All right. Good luck out there, everybody. Take care.
Bye-bye, everybody.
Bye-bye, everybody.